Alright guys, welcome back. Today we're going to be breaking down the backbone of every price move, which is market structure. Whether you're new or already reading candles, understanding structure will completely change how you see the charts. So today we're going to cover what it is, why it shifts, and how liquidity drives every move. No indicators, no clutter, just logic and repetition. So what is market structure? Structure is simply how price builds a story. Swing highs and swing lows stacked over time. A bullish structure, shown here, is a higher high and higher lows, indicated with the HH and HL, HH being higher highs, HL being higher lows. This is market structure to the upside. A bear structure, which is lower highs right here, indicated with LH, and lower lows with LL. Think of it like reading chapters. Each swing tells you where we are in the book. So, what is the point of market structure, and why does it exist? Price doesn't just move randomly, it moves to take liquidity. Liquidity sits above equal highs, below equal lows, and at obvious support and resistance zones. That's why the market runs one side before reversing. It's collecting orders before delivering in the real direction. So we're going to be going into what is a market structure shift, or MSS. It's the moment the algorithm decides to flip the direction. After liquidity is taken, the market breaks the most recent swing and starts delivering to the opposite side. That's your confirmation. We're not predicting here, we're confirming. So, in this first slide, we have equal highs and equal lows that are shown. As you can see, we swipe the liquidity of the equal highs where people think resistance is. It goes above that resistance that people say, and it comes back. People think that resistance becomes support, and instead, we get our 5-minute market structure shift here after liquidity is taken, which pushes us into the opposing liquidity, which is that low that I marked out. So the market structure is shown right here. We are in a bullish market structure with a higher low and then a higher high. We get another higher low, but then we get a lower high, and this lower high is confirmed with this lower low that breaks the previous swing, giving us a market structure shift where you could enter on this lower high to catch that opposing liquidity. You're going to see structure differently depending on the time frame. A bullish leg on a 15-minute could be a single pullback on the hourly. The higher time frame can give the direction and the lower time frame gives precision. But remember that time is fractal, meaning it moves the same on the lower time frame as it does on the higher time frame. Intraday structure shifts happen around liquidity timing. It's time and price. Time is first because it can't be manipulated. Only price can be manipulated. So the London and New York range are very strong. Between 8:30 a.m. and noon EST, watch on your price how it runs one side of liquidity and then shifts, delivering to the other. It's an algorithmic rhythm, not randomness. Here's a second example. Look how we run this London high, create a market structure shift, and drop. Let's go step by step. So going back into time, we swipe out this London high. The London high is taken right there. People find this high as support turned resistance. So they're buying right here. We create a market structure shift right here on this 5-minute swing. And then we pull back, trapping people into buys. After that, we come and tap this fair value gap in the optimal trade entry and push down into opposing liquidity. What are some common mistakes that traders find? So most traders fail here because they try to force a shift before liquidity is taken. They just pick any market structure shift and enter off that. We're not pattern traders. We depend on context and we react on what price is doing. Or they're ignoring the session timing. That kind of ties into the first one where they're just doing random times like a Sunday at market open, which makes no sense. Or they over decorate their charts, thinking more lines equals more accuracy. If you see my charts after I do reviews, there's a lot of lines and stuff. I don't always have those lines up on my graph when I'm actually watching price. I only have it to show you guys for it to make sense to you guys. This is how you're going to train your eyes. Backtest. Go to the replay mode, mark 10 examples of market structure shifts through days or months if you have to. Note where the liquidity was taken, where the break happened, and how long it took to reach those targets. That repetition builds intuition. Here's an example of how I would go back in the time. I'd mark out where we're taking liquidity, how we react to taking that liquidity, where market structure shifts are, and how I could enter it on them to target opposing liquidity. Thanks for watching, guys. To summarize, market structure tells you where price is going. Liquidity tells you why it's moving, and the market structure shift tells you when to act. Keep it simple, learn to stay patient, and let the market reveal its hand to you. Hope you guys enjoyed this little different type of video, this lecture. I hope you guys learned something insightful. Leave a like if you enjoyed or found this useful. Subscribe if you're new. Comment down what you want to see next. I'll catch y'all next time.